Let's be honest, when it comes to investing, there is really only one thing that we care about, and that is returns. However, if you're planning to get started with investing, or somebody asks you what you would like to invest your money into, you might feel a little bit silly responding with the best returning thing. What makes this so much more difficult is that with investing, there are so many different lenses that you can look at investing through. You can think about what type of risk should I be taking, low or high? Should I be using stocks or funds or portfolios? Should I be investing in my home country or across the globe? It makes it really, really difficult. Also, one of the key lenses to take into consideration is whether you want to employ an active or a passive investment strategy. And I would say that the data is in, and you can conclude that one of these is much better than the other for the average investor. Now, before we dive into the answer, let's break down what I even mean by an active or a passive strategy. Let's start with a passive strategy. And now what this means is that what you're looking to do is replicate the returns of a specific market. You're not looking to outperform it, you're not looking to underperform it, you're just looking to match whatever that market performs with. And the way that that's typically achieved is that you would invest in a very small part of every company that is listed on that specific market. And so let's take the example of the FTSE 100. That is the 100 largest listed companies in the UK. And so what you would do is hold a very small part of each of those companies. In that way, you would just achieve the return of the overall market. The beauty of that passive approach is it's extremely low cost. And if we quickly compare that to an active approach, this is slightly different in the fact that you are paying somebody or something to outperform that specific market. And the way that they might achieve that, again using that FTSE 100 example, is they won't invest in every single one of those companies equally. What they might do is only select a few of those companies or go very overweight or increase their allocation to specific businesses that they feel will outperform the others. And again, extending that example slightly further, let's say that the active manager had a really strong feeling that just one of the supermarkets that are listed on the FTSE 100 is going to perform better than the other couple. And so let's use the example of a Sainsbury's, Ocado, Tesco, all are listed on the FTSE 100. But that active manager has looked through the balance sheets, they've looked through the cash flow statements, and they're really confident that Sainsbury's is going to outperform the other two. So what they might do is only invest money in Sainsbury's and ignore the other supermarkets, thinking and hoping that that will achieve a better overall return. Now, the downside of an active approach is that actually this tends to come with a much higher ongoing cost. And so then if we compare that to a passive approach, which maybe costs something like 0.05 or 0.2% per year, an active approach might cost you anywhere between 0.45 or 0.5 all the way up to as high as 1.5 or maybe even 2% per year. And so therefore, all of a sudden, even if the passive approach and the active approach return exactly the same thing, the active approach will be worse off because you have to pay more of those returns away due to the higher cost that comes with it. And so let's get to the actual answer here instead of beating around the bush. Really, the data is in. Morningstar have released an updated report taking into account performance of different active and passively managed funds over the last number of years. And it really concludes that a passive approach has consistently outperformed an active one. And so if we take the US market, for example, which is the largest investment area across the globe, and it's likely to be the biggest allocation in any of our pensions or investments that we already hold, if we look between June 2024 up to June 2025, just 33% of active management strategies outperformed a passive one. That's a third. And considering they have always promised to add great performance, that's pretty shocking. And then even if we stretch that out to the last 10 years, so we're looking between 2025 all the way back to 2015, then that number gets even worse. Just 21% of actively managed strategies have outperformed a passive one. That's 1 in 5. And some people might say or think or argue that actually an active strategy really comes into its own when markets are performing badly. What they will say is that an active manager can actually either predict that markets are going to fall, or they'll get very active while markets are going down and they'll go overweight certain companies and protect yourself against others. But even this has been disproven, basically because markets are incredibly efficient, and it's very, very hard for anybody to know or predict when a company is at its cheapest, or which company is going to be best defended against continued stock market falls. And now it is really important that I'm relatively balanced here. And it's worth noting that in certain investment sectors, an active strategy has performed well. But I would argue that these are not really applicable to most of us as retail, everyday investors that are just looking for a consistent, well-diversified portfolio. The areas that they have performed well are around things like short-term money markets and fixed income markets, so bonds, which are extremely influenced by interest rate movements and currency fluctuations. Those are the areas that active managers have actually earned their keep and done relatively well. But it's for this reason that I would still conclude that on balance, a passive investment strategy tends to be more suited to an everyday investor.